we can say a financial report like this. This is a financial report composed by income statement and balance sheet. To make it more informative, giving you more information, we can rework the two, the two prospects here, the two formats, and we can use another. We are not changing something, okay? We can do a different prospect, a different format. For example, change the color, yes. We can use an income statement in a vertical, having a vertical format. We can start writing revenues, for example, the revenues coming from sales, then minus some expenses, okay? Then we can get an intermediate economic result, Then, okay, for example, if we consider the revenues coming from sales and expenses related to the goods, here we get an intermediate result that is called the result of the core business. It is called operating income. Then you can, for example, consider other expenses and so on, minus, you get another intermediate result and so on. And then you get the final measure of profit. Okay. So instead of a T shape, a T format like this, we use a vertical format. Is nothing different. Okay. We are only classifying, giving a specific order, and this specific order with vertical income statement can give you intermediate result that can be useful. The same for the balance sheet. If we give an order to the amount, to the different items of assets and liabilities, an order like this, for example, we can keep this T format and write current asset. It means all assets that will become money in the short term, like what is already cash, like the cash account, the bank account. Receivable will become cash in a few months and so on. And we consider the non-current asset, okay, another group of accounts. It will be buildings, okay. So the non-current, what is not transformable in money in the short term. So we have current assets that will become money in the short term and non-current asset, okay. We give a specific order. So we start with cash and we end with buildings. And on the other side, we have also, we can write current liability, like for example, payables, accruals. There are liabilities asking for money to be settled in the short term. So we have current liabilities. And then we have also non-current liability, like the loan, because the loan will last for many periods because you are asking a loan for a long time. So non-current liability, like the loan that will ask the company to have money to repay the loan in the long term. And then the capital and or equity. Okay, so this is another way of presenting the same balance sheet. Okay, and then why are they so important? Okay, it is the same information having a specific order. Then we can generate some relationship between amount in the financial report. Like, for example, I can have the so-called, we are talking about ratios. This is another way of increasing the informative capacity, ability of a financial report through the ratio. What is a ratio? Is a number divided by another one, okay? because you know that a number in isolation is not so informative. For example, when you say that the profit here is 1,280, okay, is good or not? Okay, we don't know. We can do something like this. We can consider that number, so the profit, that is this one, okay, and we compare it, we put in relation this amount with the amount of capital by the owner. And so the capital by the owner was, it was 20,000, okay? So the ratio would be like this. 20,000. Okay, and this ratio is called ROE, so return on equity. Okay, return on equity. What does it mean? If we divide the profit amount by the capital, okay, invested by the owner, we can get a ratio that is telling us that that investment of the owner in the company activity, in that business, is producing that result. Here is, for example, let me see, we calculate, this is, it is sorry. Okay, it is 6.4%, okay, if I'm not wrong. It means that this is the result of investing in the company, okay? And so the owner can, for example, compare this amount with another alternative investment, for example, to buy shares of another company or to put money in the bank and to get the interest, okay? Then can use this ratio to try to understand what is happening year by year. So this year, the amount of the return on equity is 6.4, and maybe the year before it was less or more. So, and you can decide for something. Okay, so this is another way of recombining information in financial report to get more information. Then we have, for example, you will see this all this analysis of the financial report in a specific course. You will have the second year, which is called financial statement analysis. So financial statements, so financial report analysis. Okay, you will see it. Another important ratio, it is like this. It is the ROA. So it is putting together return on assets. So you write on the top of the ratio, you write the amount of profit, and then profit on the amount of the asset, okay, invested. Okay, it's not very good, but return on asset. You know, this is another ratio that is telling you what is the